Hey friends, in the video today, I want to talk about something scary. As a dividend investor, one of the worst things that can happen is falling into a yield trap. For those of you that don't know, a yield trap is a dividend stock that pays a high starting dividend yield, and it draws a lot of dividend investors into it because who does not want high yield right away? But the trap is that the company eventually ends up cutting the dividend, and then the yield that everyone thought they were getting, it's completely gone. And so a yield trap is a very scary concept. I just did a video recently, I'm going to link in the pinned comment below, about an investment that I have made. This is a smaller ancillary position in my portfolio. In fact, it's less than 1% of my portfolio, but every stock in the portfolio plays a role, and I analyzed a company called the Campbell's company, ticker CPB. And I received a lot of comments on this video. Many investors liked the video. They thought, hey, Ian, your analysis makes sense. Others had some really constructive criticism. Some of them really did not like the idea of this company at all. In fact, it's very important as an investor for everyone watching at home, please formulate your own opinion. We all take different journeys as dividend stock investors, and it's very important to have this kind of debate in the community. But it was funny. On that video, I received comments that were a little bit stronger, I would say, than normal. Check it out on the screen. You can see here one investor called the stock trash. Another investor called the stock crappy. Another investor said, hey, the payout ratio is over 100%. I disagree with that based on my analysis. Another investor said, Ian, your stock that you're covering is terrible. Usually I don't receive these kind of comments on my videos, and so that was really interesting. As a side note, as a contrarian investor, when the pessimism is that high, it's something I take note of. Sometimes it can be an indicator that my contrarian investment actually is worthwhile. I like it when there's a lot of pessimism. But nonetheless, let's talk today about the concept of the yield trap. I'm going to do this through comparison. And times are changing right now. Times are changing. And so a while ago, I was actually reviewing a company. I do this a lot. Throughout my week, I like to audit and look at the financials of a lot of dividend stocks. I'm always looking for new dividend stock investing ideas. One that caught my attention was the Dow company, Dow Inc., Dow Chemical Company. And in fact, I passed on it when I looked at it a few months ago, even though the yield was 10%, because I was concerned, Ian, this could be a yield trap. And it turns out that that was the case. They actually just cut the dividend in half. In fact, check it out on the screen. Check it out right now. You can see on the screen the Dow company, ticker DOW. They were paying the dividend of 70 cents per quarter all throughout history, and now it's 35 cents. They cut it in half, as you can see on the screen. And so times are changing, and it's important as dividend investors to be cautious of yield traps. As you can see on the screen in front of you right now, times are changing. Look, there are negative operating cash flows. I'm going to get into this in more details in the video later. At some of the chemical giants, including Dow. They cut the dividend by 50%. The statement of cash flows, which I will cover later, is ugly. This is an example of a yield trap. These are companies that once thrived. Is the Campbell's company a yield trap? I don't think so, but only time will tell. So here's what I want to do in the video. I want to compare Dow versus CPB. I want to show why Dow became a yield trap, why I don't think at this moment in time CPB is, but I could be wrong. This video is just for fun and entertainment. I'm not providing investment advice. This is just for the fun of sharing my personal journey online. So only time will tell. But I want to compare the two. Check it out on the screen in front of you right now. So what you see here first is the financial metrics of both companies. Dow is on the left, Campbell's is on the right. And what you can see is Dow is down 55% from its 52-week high. You can also see that in 20 2025, the company is expected to lose money on an EPS, earnings per share basis. 2026, it's only going to earn $1. And so the PE is negative this year. Next year, the PE ratio is still pretty high at 24.93, and that's after it fell a bunch. So the dividend, after it was cut, is now a 5.6% yield. You can see why I was looking at it a while back, because the yield was 10+%. I take note of those kind of things as a dividend investor. And so you can see the 5-year dividend growth rate is a negative 12.9% per year. Market cap is $18 billion. Now, in this illustration, I have some metrics on here that I've not shared in prior illustrations. Today, I want to look at the cash flows analysis. I'm going to share the statement of cash flows for both companies, but I summarize it here for you on the screen. As you can see in front of you right now, I like to look at the statement of cash flows to understand if a company can kind of cover the dividend. This is how I can quickly spot if a company may be a yield trap. I thought that the Dow company could be a yield trap, and it turned out to be so because of the cash flows. So, as you can see on the bottom left of the screen, the operating cash flows, and this is, mind you, for the 6 months ended of June 30th of last year, 2024. I used the cash flows from last year because they were better than this year. This year, in the 6 months ended June 30th of 25, they had a loss of $379 million in their operating cash flows. And so I used the 6 months ended 6/30/24, which was an operating cash flow of $1.3 billion. I gave them the benefit of the doubt. I said, hey, what if things return to what they were last year? But let's look at the dividends paid. So the dividends paid were $984 million over the same period. I do kind of a ratio here. What are the dividends divided by operating cash flow? 76%. And that's on the better operating cash flow from last year. So this is key. I highlighted in yellow. For this company, Dow Inc., the ratio of dividends to operating cash flow is 76%. This metric, by the way, doesn't even take financing, debt service into account. I'm just trying to see at a high level is the operating cash flow, how much of that is going to be used up by dividends, and it shouldn't be this high. It shouldn't be this high. And that was a red flag to me. Now I want to compare this with the Campbell's company. Check it out on the screen. On the right-hand side of the screen, in the right-hand columns, you can see Campbell's. They're down a lot too, 38% from the 52-week high. Mind you, though, since I did my video, it's already up 7.5%. My patrons already know this. I'm going to link to my Patreon in the pinned comment below. I share all kinds of bonus content over on Patreon. It's awesome. But one of the things I shared with my patrons is I made another purchase, but now I'm not because Campbell's went up too fast. It already jumped like 7.5% from where I bought it. If it gets back down towards the really low 30s, like 30 and change, or the 29s or something like that, I hope to buy again. But right now it already jumped up. This is what happens when I see value in the market, like true value. Sometimes these stocks kind of get away from me. And that's just the game. That's how it is. But as you can see on the screen in front of you right now, on the right-hand side of the screen, you can see that Campbell's company is down 38% from the 52-week high. Based on the earnings estimates for this year and next, the PE is in the 11s. That's something just to take note of right away. From an EPS standpoint, this doesn't really look like a yield trap to me because they're earning a lot of money and the PE is low because it's trading at a discount. If this were a yield trap, it would be tanking, but the PE would be really high, like it is for Dow. Anyway, we keep going. The dividend yield now is 4.7%. Like I said, I want to buy more like 5% yield on this thing, but that's not the case because it jumped up 7.5% from where I started buying it recently. Payout ratio, 53%. You can see again, that's kind of an indication it's not a yield trap because the payout ratio is low. But payout ratio is based on EPS, earnings per share. I want to look at the cash flow statement, which I'll do in a minute. They recently increased the dividend this year for their January 27th payout by 5%. That's another indication it's not a yield trap unless things were really crazy. But management, generally speaking, would not increase the dividend if they could not pay it, and they just increased it this year. They're growing the dividend slowly, only 2.2% per year on average, but that's a lot better than shrinking. $9.9 billion company. Here's where it gets interesting. At the bottom, on the bottom right, operating cash flow for the 9 months ended 4/27/25 is $872 million. Dividends paid over the same period, 9 months ended 4/27/25, is $343 million. 39% dividends divided by operating cash flow. This is really the point of the video. I'm introducing a new metric. Dividends divided by operating cash flow. Doesn't take financing into account, doesn't take debt service, but it does take into account, just in general, operating cash flow from the company. Does it cover the dividends? To an extent where it's not at risk of a dividend cut. In the case of Dow, I didn't buy it. I was worried about it, and my thesis turned out to be true. They cut the dividend. With Campbell's, this ratio is so low, I just don't think in the short run that they're at risk of cutting the dividend. But again, only time will tell. So let's just look at this a little further. I want to share the cash flows statement with all of you. Let's look at it, check it out on the screen. The first cash flows statement that I want to share with all of you today is Dow Company. And there's a lot of numbers here, but the most important thing is look at this cash provided by or used for operating activities, aka the operating cash flow. You can see the numbers there for the 6 months ended June 30th of 25. They lost money, $379 million. In the 6 months ended June 30th, 24, they made $1.3 billion in operating cash flow. That's actually the number I pulled to give them the benefit of the doubt. It's even worse if you look at this year's data. But anyway, let's go down the screen. If you go under financing activities, if you kind of keep going down, the last one in that section is dividends paid to stockholders. And that's where I see $990 million this year, $984 last year. You can see it. They're just paying out a huge amount of dividends, but they just don't have the operating cash flow to cover it. And so that's where the cash flows, the statement of cash flows comes in really helpful as a dividend investor to understand if a stock you're looking at is a yield trap or not a yield trap. It's that simple. I just like to look at it. Check it out now on the screen, the Campbell's one by contrast. Let's look at it. I don't have to cherry pick the best numbers here. I'm just looking at the 9 months ended this year. April 27th, 2025. Net cash provided by operating activities or operating cash flows, $872 million. And yeah, it's kind of down a little bit from last year's $897 million, but I think they can hold that. I think they can hold the line. And all I'm looking for on this particular investment is just that. I'm looking if I can lock in a nice almost 5% yield at a stock that's trading at a PE in the 10s or 11s. And I'm seeing if I can get that 5% yield in perpetuity. That's the goal. And I'm trying to see, is it a yield trap or not? Well, if I scroll down here, if I keep going down on the page, we can see dividends paid. There's a row called dividends paid, and it is $343 million. You can see right there, $343 million. Again, this is a very high-level analysis. I'm not looking at debt servicing today, but we can at least see at a high level that the dividends are not taking up all of the operating cash flow. I don't think the Campbell's company is going to cut the dividend. They just increased it this year. But again, it's a small position in the portfolio, less than 1%. For some reason, it triggered a lot of people out there. But again, that gives me even more confidence. I love it. I love it. I want to close out. I have a few more notes, as you can see on the screen in front of you right now. So what I want to share to close is just questions. This is for deep value investors. I look at CPB right now as deep value. Is the company obsolete? That's a question. Or is it going through a complete structural change that negatively affects the fundamentals on a permanent basis? So it might not, look, I don't think Dow is obsolete, but I think it's going through a structural change, and I think it affects the fundamentals on a permanent basis. Management wouldn't have otherwise cut the dividend by 50%. So that's a question. Another question is, or are the obstacles at hand possible to overcome? And it doesn't even have to be a growth scenario. Can the obstacles be overcome enough just to continue to pay the dividend? This is where I really see CPB right now. I think that they can kind of overcome some of their challenges that they're facing right now. Stock wouldn't be down if there weren't challenges, but I think they can overcome it enough to be able to pay the dividend. As a dividend investor, that's all I care. I'm not really looking for capital appreciation, although I think some could be there over time. And I think some continued dividend growth too. But these are important questions for deep value investors. Also, it's important to note that financial statements can help us understand the answers to these questions, at least in the short run. I think today's example is important because it involves the statement of cash flows. So that's where I'm at. That's where I'm at with these stocks. I think I had a few more thoughts I want to share with all of you today that I put together. So check it out on the screen. One last slide. In the last slide, look, deep value investing carries risk. It's important to look at the financial statements, the real numbers. This is important. We all have different levels of risk tolerance. My risk tolerance allows me to buy Campbell's at a less than 1% of my portfolio. Some others may hate it. That's great. We are all different investors, but it's important to remain humble, avoid the hubris. It's important to remain open to other perspectives. And just because someone has a different perspective than you might, hey, who's to say who's right or wrong? We're all different investors. It's important to respect your fellow investors, even if their views may differ. And it's important to realize that not all deep value investments work out as you planned. However, it's the aggregate that matters. It's important to have more winners than losers and bigger allocations to the winners. Some value investments will warrant a huge capital allocation. Others will be ancillary. And on that note, look, CPB, I like it. It's less than 1%. I'm adding, especially if it goes lower again. But you might remember I went really big into Altria and BTI. Those deep value investments paid out for me really well. They worked out. And so not all of my deep value investments work out so well, but they did. And I was fortunate enough to allocate really heavy to them. In fact, Altria is now the number 2 largest position in my portfolio. My patrons, the corner patrons, already know that because I share my portfolio over there on a quarterly basis with the percentage allocation to each position. I'll link to that again in the pinned comment below. Thank you for watching today. If you enjoyed the video, please go ahead and click the like button. It means the world to me. Also, if you enjoyed the video today, please go ahead and consider subscribing to my YouTube channel. It also means the world to me. Before I go, in terms of a full disclosure, I am long the stocks mentioned today, some of them at least. I'm long the Campbell's company, ticker CPB. I'm long Altria, ticker MO. I'm long British American, ticker BTI. I own those 3 stocks in my personal dividend stock portfolio. Before I go, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Before you go out and invest in the stock market, please consult your licensed investment advisor first. I'm just sharing my personal journey with all of my successes, all of my setbacks as well, for fun and entertainment purposes only. As always, I have my disclaimers in this description below. Thank you for watching. I appreciate all of you. I can't wait to see you in the comments below, and I'll see you in the next dividend stock investing video.